Hi everybody, welcome back to Life of Dad and to part 3 of my series on how to buy a house. In part 1, I broke down the process into 7 steps, and in part 2, I talked about the details of the first step, which is learning the market. So if you missed either of those videos, I'll have links to them in the description for this video. But if you saw those videos and are enjoying the series, please hit that subscribe button. It really helps out the channel and also lets me know what kind of content y'all like. So with that out of the way, in this video, I'm going to talk about the details of step 2, which is securing funding, and I'll talk about the different types of lenders, how you should compare different offers, and also all kinds of preferential treatment for your loan, which you may not know about. I'm not planning on going into details on how lenders decide how much money you're allowed to borrow, because all those rules about debt to income ratio can easily change, but I will talk about what you should be thinking about when you're looking for a lender. First, let's talk about the different types of people that you may reach out to when you're trying to secure funding. 3 common types of lenders are banks, credit unions, and mortgage brokers. Now, banks are banks, that's pretty obvious. And if you have a bank that you like doing your banking with and you already have an account, you probably do want to reach out and see what kind of rates they offer. But keep an open mind about getting a mortgage from a bank that you don't currently have an account with. We ended up getting a mortgage from a different bank than our regular one, and I'll talk a little bit about why we did that. But keep in mind that it's highly likely that if you do get a mortgage from another bank, you will probably have to open an account with them and also use their payment system for the mortgage. Credit unions are kind of like banks, but theoretically they're not for profit, and conventional wisdom says that credit unions will offer you a lower rate than either banks or mortgage brokers. And that's true. The second best offer that we ended up getting was from a credit union. They had the second lowest interest and second lowest lender fees. Finally, mortgage brokers act as intermediaries between you as the borrower and different lending institutions. Theoretically, they have a good feel for the market and what's out there. They shop around rates, and they're supposedly saving you the work of trying to find the best rate. However, most of these mortgage brokers operate on a commission, and they may have a different incentive structure. Still, like I said, it doesn't hurt to reach out and see what kind of rates they're offering or are able to find you. And personally, I recommend getting one referred to you. It could be from a friend who's used one, or maybe a real estate agent. But it's important that if you get a referral from a real estate agent, then ask them if they have any financial relationship with this specific mortgage broker and if they're getting a referral fee for sending you to this broker. When we were looking for mortgages, I got quotes from 7 different lenders. And that might have been a little bit of overkill, but it certainly didn't hurt. The first 3 were preferred lenders from my employer, meaning they had some kind of a deal where these lending institutions agreed to waive the lender fees for employees of the company. And these were kind of a mix of banks and mortgage brokers. But don't get blinded by the no lender fee thing, because I got quotes from 2 of these lenders and their interest rates were significantly higher than other quotes that I got. And besides that, the lender fee is just a specific part of the fees that you end up paying. And it ended up that their other fees were still higher than the competition. The third preferred lender from my employer was super pushy. She kept wanting to submit my info for a credit check before I was ready. And basically she made me feel like I was there to provide service for her. I cut that off very quickly, because one thing you need to understand is that until you actually close on your house, you need to be working with your loan officer, and you have to trust that person, and you should trust your gut about them. You don't want to be making one of the biggest financial moves in your life working with a person that you don't like or don't get along with. Any red flags, you should just immediately cut them off and don't even give it a second thought. There's plenty of options out there, there's plenty of competition, and you can find somebody whose personality meshes with yours. So those were 3 out of the 7 lenders that I talked about. I also reached out to a credit union that I was a member of during university, and they actually had a great offer. They had the second best offer, and we would have gone with them if we didn't have a special loan option. I also reached out to 2 mortgage brokers. Each of those was referred to us by a real estate agent that we met during our learning the market phase, which is what I talked about in the previous video. And one of them actually had the third best offer. And finally, the one that we went with was a bank that we didn't previously have a financial relationship with, but they gave us a special loan option that the others didn't. So there are different preferential treatments that you can get if you fall into one of several categories. For example, if you're a veteran, if you're a healthcare employee, if you are a first-time home buyer, etc. There's different preferential treatment that you can get. So this bank actually offered us the best interest rate, the best lender fee, and also the lowest down payment requirement out of everything. So basically it was a no-brainer for us to go with this one. For this specific bank, we also had a really good feel about the loan officer. And like I mentioned earlier, it's really important that you get along with your loan officer and understand what type of person you're dealing with. And to get a feel for them, you should ask a lot of questions, and even ask questions that you already know the answer to. That's kind of what I did. I talked to several different lenders and I asked them all the same questions. And then I could compare how patient they were, what kind of level of detail they went into, how knowledgeable they seemed to be, basically what kind of service are they going to be providing me. And if they can't give you good service when they're trying to sell you, then you're going to be in for a bad time when you're trying to close your loan. But one thing you need to understand is no matter who you go with, they may not end up keeping your loan on their books. So what a lot of these lenders do is they'll get you to get the loan through them and then they'll turn around and they'll sell it to one of two quasi-governmental organizations known as Fannie Mae and Freddie Mac. And that way they get to bank the return on that fee right now rather than have the risk of you defaulting on the loan on their books. And sometimes they will decide to keep your loan, and that's called a portfolio loan, meaning that your loan is part of the bank's portfolio. That's sometimes nice because you know which institution you're going to be dealing with and you get to stay with them and you don't have to worry about it changing partway through. But either way, it's pretty common for the person servicing your loan to change, so don't worry about it too much, but just understand that that's another thing that you can ask the loan officers, whether your loan is going to be staying with them or going to somebody else. So what are some of the important numbers you need to keep in mind? Number one is the interest rate, of course. This is by far where you're going to be saving or losing the most money, so keep that in mind. Number two is the lender fees. The origination fee part of that is probably where the lender has the most control, and the other fees are more or less the same across different lenders, but it certainly doesn't hurt to go through all those fees line by line with at least one of the loan officers so you know what they're charging you for. Another really important number is the down payment. You need to keep in mind that you need to have enough money on hand, not just for the down payment, but also to cover additional closing costs, for example, like the title company fees and other costs. And if you're going for a 20% down payment and you end up getting into a bidding war over the house and you up your offer, then you've also just upped that 20% that you need to put down. If you decide to put down less than 20%, then you'll typically have to pay something called private mortgage insurance, or PMI, which is a monthly payment that you have to make until you have 22% of the loan paid off. Not 20%, 22%. And the name is a bit misleading because you're not actually insuring yourself. You're insuring the mortgage company in case you default. So basically, it's just money sunk down the drain. Additionally, if you decide to take less than 20%, or generally the lower the down payment you put down, the higher your monthly payments are going to be because you're loaning a larger sum. And in some cases, you may actually get worse loan conditions, like a higher interest rate, if you take a lower down payment. Some of the special loan options will allow you to take a lower down payment than 20% without having to pay PMI. So you need to be aware if you fall under one of the categories that lets you do that. Another option that you have are points, and points are basically an extra upfront fee that you pay in order to reduce your interest rate. And there's a quick calculation that you can do to figure out whether those points end up paying back for themselves at all, and if they do, how long does it take? And each case should be weighed on its merits, so I'm not going to give any blanket statements on whether or not you should take points. Personally, we didn't take points, and we also decided to put down less than 20% because we had a special loan option that allowed us to do that without having to pay the PMI, and we wanted to have a little bit of extra cash to do renovations on the house before we moved in. But we did that with the understanding that we were going to have a higher monthly payment because we were taking a larger loan. And I'm also not going to comment about what term you should take your loan for and whether you should take a fixed loan or an adjustable rate loan. We got our loan back when interest rates were very low, and so we went for a 30-year fixed loan so that we would have lower payments and stability in the payments that we were making for 30 years. But again, each case needs to be weighed on its merits. When you're trying to figure out how much house you can afford, don't listen to the lenders. Do your own math. Only you know what your other monthly expenses are and how you anticipate those expenses changing. For example, are you planning on having kids? Do you have a big trip plan? Only you know how secure your current job is and what your future earnings potential is. And try to be conservative. You want your house to be a safe haven that you come to and not an anchor that's weighing you down in debt. And keep in mind that even if you get a 30-year fixed term loan, your housing costs are not going to be fixed. Yes, the principal and interest part of the mortgage are going to be fixed, but now that you're a landlord, you're responsible for all of the maintenance costs. Additionally, you have to get homeowners insurance. In some cases, you have to get other insurances. Like for us, we had to get flood insurance, and you also have to pay property taxes, and those are not fixed. And spoiler alert, they tend to go up. So you need to account for all of these not so little expenses that you may not have thought about before when you're deciding how much house you want to buy. account for the moving costs, potentially buying new furniture, and have a little bit extra on the side in case something goes wrong. In our case, a few days before we were moving into the house, it was a hot Texas summer and there was a leak in the AC line that caused all of the Freon to leak out. And by the time we were done, we were out $1,500 that we hadn't planned for at all. So you need to keep all that in mind and be prepared to make sure that you have a positive experience buying and moving into your house and living in it, and you don't realize that you bought too much house. That's all I have to say about securing funding. I know there's a ton of little details that I didn't talk about, but I tried to hit the really big stuff where if you screw that up, you're really gonna pay. If you think I missed anything important, please let me know in the comments below. And if you got any value out of this video, please give it a like and consider subscribing. Thank you all for watching. See you all next time.